Hello, everyone. I'm Fairport Wealth's Managing Director and Growth Officer, Andrew Connors, and we're welcoming all of our clients and friends across all of our offices in Buffalo Grove, outside of Chicago, Illinois, Cleveland, Ohio, where John and myself are currently sitting, Harrisburg, Pennsylvania, Buffalo, New York, as well as Princeton and Cherry Hill, New Jersey. And as always, it is a pleasure to serve you and inspire you and your families. In today's conversation, what we'd like to do is cut through some of the noise and headlines that are obviously very pervasive these days and connect with John Silvis, our Chief Investment Officer. We've collected a range of questions around different topics that myself and my colleagues have put together that we think will be of value to you and provide insights on the current state of the markets and the economy. There's a number of ways we share this information. There will be a replay of this webinar that goes out. There is also email updates that go out. The last one on the markets and economy was sent out on July 2nd, so I want to make sure you're getting that. There's also a weekly update that's available, which if you would like to get a copy and on the list of that, reach out to your advisor, let them know. And with that, we're going to get things started here. So, John, I want to kick things off with just kind of taking a step back here. We have just crossed the midpoint of the year. And it feels like, from a market standpoint, we've crammed a whole year worth of market activity into the first 6 months. So between the good, the bad, and the ugly, to use a Clint Eastwood euphemism from his movie, how would you classify the state of the markets these days? Can you summarize things for us, and what do we see happening in the second half of the year?
Yeah, well, there's never a dull moment in the markets, right? And we've seen that over the last 6 months. As you mentioned, we had quite a bit of gyrations. I think a lot of things went through. We had the budget issues earlier in the year, which I think most people already forgot about, and that was passed uh, with a continuing resolution. So that was one. We have the big beautiful bill, which I think was just signed last weekend. That's taking the tax rates from the previous Trump tax cuts and making them permanent. We can talk about that if you'd like. We did lift the debt ceiling, which was another thing that was hanging out there. And then so far, although we've gone back and forth on these tariffs, they're lower than they were before. So I think those have peaked. So it's been a crazy first half of the year. As we sit here today, as you mentioned, if you would just wake up today and look at it, we finished the first half of the year at 6.2% return on the S&P. Historically speaking, that's not too bad. We're a little over 7% as of Friday. Today's a Monday that we're reporting this. So it doesn't, on paper, it looks like an average year, but we've had quite a bit of volatility in the markets. But, as we are today, we're going to get second quarter earnings here in a couple of days. I think we're going to realize that the earnings, at least for the second quarter, were better than we expected at the beginning of the year. So that's a positive. I think probably more important will be the guidance going into the third quarter, and with the uncertainty in tariffs, and you're going to hear us talk about that a lot today. I think that's going to have some impact. But overall, I think the markets are on pretty firm ground. I think the threat of a recession is not very high, or has been waning throughout the year, and we can talk about that. We have the Fed still talking about cutting rates at some point this year. I think they will. So we have that as a tailwind. So, overall, as normal as things could be, and I don't know if there ever is normal markets, I think things look okay. A lot of uncertainty, but they always say that's kind of what makes a market. So there's still a laundry list of things to worry about, but I think we've been kind of picking them off one by one as we got to this midpoint of the year.
So I kind of want to follow up that question with a thought. On January 2nd, you sent an email out internally and to all of our clients where you kind of highlighted different themes and thoughts for the markets for the year. And your first theme and thought for the market for the year was that we were overdue significantly for a market correction. So we have obviously had a pretty significant and unpleasant market correction. What is the likelihood you see further volatility during the year? And I think what was interesting about this correction is that it was a lot of the downside was largely driven by a small concentration of technology stocks. And so would love to hear your thoughts around the concentration of returns that we've seen in the market, especially around these stocks? And then how do you see that theme playing out the rest of the year and going forward?
Yeah, so at the beginning of the year, one of our thoughts would be probably see a correction of 10% or more. But that's really just math. If you look at the markets over a long period of time, they tend to correct 10% once every year, 5% 2 or 3 times a year. And we didn't have one last year, so the thought was we were probably overdue and we would see one. And honestly, within a bull market, and you were talking about the market direction, having corrections along the way is not unheard of, and in fact, it's probably healthy for the market. So that wasn't a big shock to us. You always get shocked, or you always get a little concerned about how fast and when they happen, because if everybody knew exactly when a market correction would be, it would be a non-event. But because they usually come when you're not expecting them, or there's some event out there that wasn't foreseen, they always tend to be pretty painful as you go through them. But again, I think this one was down about almost, I think it was around 19%. I think we're still in the bear market. I'm sorry. I think we're still in the bull market from October of 22. And that's been just starting on its third year. They tend to go at least 5 years or more. So I think we have further upside from a directional standpoint. As far as the what I think you're referring to is like the Mag 7 stocks, the high.
Exactly, yes.
Yeah, which if I was pressed to name all seven, I would probably miss one. But within that group of stocks, they have been the market leaders for the last few years, and/or the market decliners, if you want to call it that way, which we saw earlier this year. I think that's kind of played out. If you look at the markets going forward, or really just since the bottom in April, so the last, call it, 2 to 3 months, those stocks have kind of reemerged as leadership going forward. And I think, to answer your question, I think we'll see that continue at least throughout the end of the year. We have been overweight cyclical stocks for a while. We have refocused on that. We still like the growth area versus value, really more cyclicals versus defensive. We can talk about that if you'd like. And then I think the one that leads that group is technology. And there's a lot of themes to that, and we can talk about AI and those things. But I think from that group of seven, and it could change. It could be 4 out of those 7 or 6 out of those 7, or it might be 2 additional new ones. But I think that core of what is mega cap technology names that are high leverage to the economy and AI, I think they'll continue to be leaders throughout the year.
Isn't there anything on the horizon that you think could change that dynamic, or are the themes driving cyclicals and technology so entrenched that the visibility there is pretty good?
So, I think as far as cyclical goes, those tend to be consumer discretionary, technology, and industrials. Those tend to be the 3 big ones. And we're overweight all 3 of those currently within our large cap model. And they tend to do well when the economy does well. Now, we can talk a little bit about the economy currently, but it's still holding, I think, pretty firm. I think it's on solid ground. You could argue maybe it's slowing going into the second half, and we still have a lot of issues with tariffs. So that remains to be seen. But as you look at it today, I think the economy looks, somewhere around 2% growth or better. So I think that you want to be overweight cyclical. So that's, I think, one area that we like, and we would continue to be overweight. I'm sorry, what was the second part of the question?
Well, actually, I'm gonna keep on this train of thought, because another point I want to bring up that I think is lost on a lot of people is, we always talk about diversification, and this is a year where being diversified across asset classes has really resulted in a much different and better, call it, risk return profile. So would you mind sharing some of your thoughts around just diversification across asset classes, domestic, international, and how that's impacted portfolios this year?
So international equities came out of the gate much stronger than domestic equities. Doesn't matter if it was large, mid, or small caps. So international equities, and I would include both developed markets and emerging markets in that group, did quite well in the first half of the year. They started to wane a little bit recently. And I tend to think that their outperformance is probably stalled at this point. And I think as we go into the second half of the year, you'll see domestic equities outperform. But one of the driving factors, and there's many of them at the beginning of the year, for international. One, the dollar was declining, so that tends to be beneficial when you translate profits. And then the other thing, um, you know, all the issues with the tariffs and which countries would do better than others, and you know, I think that's a long story. We're going to play that out throughout the year. I know there's been a couple more announcements recently, and there's deadlines that get pushed out, and we'll see how those play out. But I think there's really only a couple trades here. I think growth, domestic, and technology tend to be one trade. International value and defensive tend to be another trade. So I think if you're going to be in one group or the other, that's kind of how it's going to play out. And I do think that we've seen a reversion back to those more growth oriented, more cyclical names. And I do think that has a couple reasons. One, the economy didn't go into recession driven by tariffs, or at least it hasn't yet, and it doesn't seem to be. I know the Atlanta Fed does their GDP now forecast, and it's forecasting about 2.6% GDP growth in the second quarter. Goldman just put out their estimate, and they raised it to 4% in the second quarter on an annualized basis. So I think the economy is on better ground. You're starting to see that be reflected in some of the underlying names. And I think the other thing is, you know, we're still in an early cycle of this AI rally theme, if you want to call it that. I hate baseball analogies, but I hear it all the time. We're probably in the second, maybe third inning. I don't even think we're there yet. So I think there's a long way to go, and I think this will be a long-term phase. So I think this is just a resumption of the trend, not really a counter trend that we see run out for a long time. So I still like international. I think emerging actually looks very, very attractive out there. And they did have a moment there at the beginning of the year. We'll see how it plays out in the second year. Doesn't mean they can't have a positive return over the next 6 months, but they may not be the market leader.
Got it. So you mentioned tariffs haven't had a significant impact on the economy yet, but I don't think an hour goes by anymore these days where there's not a news blurb or quip around what's going on tariffs or off tariffs. And so where do you see tariffs impacting the economy, and where do you see this being more noise than news?
Well, you know, that's a great question. If I wish I had a crystal ball to give you a great answer on that one, but you know, we have seen over the course of Liberation Day, I think that was April 2nd, if I'm not mistaken. We've seen several deadlines. We've seen them move. I think the most recent one is August 1st, if I'm not mistaken. And I think that's going to have a lot of impact on the markets and the economy. I think the reason we saw a negative first quarter in 2025 from a GDP growth standpoint was because people pulled all their orders forward in the fourth quarter, very little second quarter, and now they're ordering again in the second quarter. And I think, you know, you can see that where it gets very disruptive, and it makes it a choppier a return from a growth standpoint. Doesn't mean it's not a positive growth, but it just gets choppier. And I think we're going to see more and more of that. So I think the overhang of tariffs is going to be there for a while. We haven't really seen it so far. I think it was Andy Jassy, who's the CEO of Amazon, said he hasn't really seen it manifest itself in prices broadly. And you know, Amazon being the biggest retailer out there, that's a positive sign. But as we get closer to these deadlines, and we're going from 20 to 30 on some of these countries, I think Canada was 35 or something like that. You're going to see that creep in eventually. So far, inflation has been relatively tame. I think we're at 2.4 on headline, but you know, the question is, has that really creeped in? Has the tariff overhang really creeped into prices yet? And I guess that's one of the unknowns for the second half of the year that we're going to have to deal with as we go forward.
Gotcha. You were talking about AI real quick, and I want to revisit that topic. So whether we're in the second or third inning, I think we all agree we're in the very early stages, and there's still a lot of runway left. I'm just curious. I'd love to hear, what data points do you and the investment team focus on in terms of gauging, I guess you could say, health, and where we're allocating funds, and how do we get exposure to the AI theme that is kind of so pervasive out there?
Yeah, well, it's dominated by very large mega cap corporations, where most of the smaller ones get bought up pretty quickly. And it's really been in a couple of different areas. One is semiconductors, and that's an area that we've had exposure to, and we're actually overweight those names within our portfolio. But I think there's a progression as you go through this, and again, this could be multi-year progressions. But I think it starts off with um, semiconductors. One of the other areas which I think is now doing very well is the software end of it. How do you take that AI and how do you implement it within your business? I know here at Fairport, we've been using it through Microsoft. So there's ways you can do that. There's 100 different variations of it or different options. We use Copilot, but that's just an example of one. And then I think where you see it start to take place, and I think again these can take years to go through, is more in the cybersecurity area. How do you make things secure? How do you use all this software and programming and not have it affect clients or your business? And cybersecurity is becoming a big issue, and they tend to be dominated by very big corporations. And I think that's kind of the progression. And then eventually, how does this all creep into the retail space? How does it creep into the consumer space? I think we're really early on that, but I think as we go, into the next couple of years, maybe the next 10 years, they're going to start to see that creep into, how do we use it in everyday life? And I think that's coming. I can't tell you how many times I've heard people, used to be back in early 2000s, people would say, what is your China strategy? Now it's like, what's your AI strategy? Everybody has to have a strategy for that. If you don't have one, that's a concern. So far, those companies have done very well as far as growth. They have some of the best growth rates out there. They have some of the best earnings out there. It's important, and it becomes a higher bar every time. So eventually you'll see them maybe miss what is probably too high of expectations, but they're still growing, very quickly. And then you can even take it to the into the real estate space with data centers and things like that. So there's a lot of opportunities to benefit from that. We've been focusing more on the early parts of the technology phases, but I do think that'll start to work its way through the rest of the economy and markets as well.
Gotcha. A number of meetings that we've been in, especially with business owners in the manufacturing space, have all brought up, call it reshoring of manufacturing. So I'd love to hear your thoughts again on that topic. Is that something that you are seeing? Do you see it being permanent? Are we exploring how that impacts portfolios? What are your thoughts?
Yeah, it's to be honest, it's probably not something we put a lot of thought to. I think we hear about it a lot. I think it goes back in just the overall manufacturing. And there was an old saying, not an old saying, there was a saying a couple of years ago that the best emerging market was the Midwest. So because people continue to they're realizing being in China now, especially as the labor costs in China have gone up, that they moved to Vietnam. Now we have tariffs. So there's been a big push, especially from some of the bigger companies, and administration is pushing it as well to bring some of that manufacturing back. I don't know if there's a direct play on that or not, other than looking at some of the industrial names that we already own that are going to benefit from some of those things. But it's definitely a theme out there. It hasn't been one that we put too much into. I think, one of the themes that we've been looking at a lot, and we've started to work into our portfolio, is the tie into the millennials. I'm sure everybody knows a millennial at this point in life, or you have kids that are millennials. They're becoming the biggest demographic group out there, and they like to travel more. They like the experiences more. So we've been looking at areas of the market. How do you capture that? So we bought a few. We bought a cruise line recently and online travel agency. And I think that's a long-term theme as well. So those are a couple things. The reshoring one we've talked about, but not really have put too much emphasis into it yet.
Gotcha. I want to shift gears real quick. So everything we've been talking about has kind of been more equity focused, and not obviously all of our clients have 100% exposure to equities. So most people have call it defensive assets in their portfolio, and I know that's been a big area of focus in the past couple of years. And I know going forward is what is the best way to manage the non-equity or defensive piece of the portfolio? So would love to hear a little bit of, and have you share some of our thinking around bonds versus liquid alternatives versus private market alternatives, which have also started to become much more of a front and center investment theme.
Yeah, so bonds have had a tough run the last couple of years. I think they're just about flat over the last 5 years, and we use the Bloomberg Aggregate Index as kind of the benchmark for that. Some have done a little better or a little worse, but the overall benchmark has been about flat for the um, last several years. And yields. So to answer your question, I think bonds still hold an important part of the portfolio. I do think we had 31 years of rates kind of declining from the peak in the early 80s. I think that's kind of over. I don't know if we're in the bottoming process or we're going back up. I think the yields for the 10-year, and we kind of use that as the benchmark, the 10-year treasury were 480 at the beginning of the earlier in the year in January. I kind of think that's the high for the year. We're like somewhere around 450-ish, I think, if I'm not mistaken. So we could see it go back up, but we do think the Fed's probably going to cut rates. So we still think bonds have a place in portfolios. But one of the things we've been using, especially when rates were really low back in 2020, 2021, is using some hedged equity, which is one of those liquid alternatives you mentioned. And what they do is it's a pretty simple process where they try to put a buffer in. So after 5%, you try to buffer the losses for the next 15, and it gives you a little bit. It gives you equity exposure, but then it doesn't give you as much volatility within that holding, and it's worked out pretty well. Still like them relative to bonds. We only use 4 or 5% in portfolios, but I think that's an area we currently like. We may not always think that's the case, and if we see rates start coming down more consistently, and I do think the Fed will cut rates at some time this year. My colleague Rick D'Amico kind of thinks it's going to be in the second half of the year, probably 2 times, but that's kind of up in the air. I know President Trump and Chairman Powell are having a war words. Well, the president's having a war words on this, so we'll see how that works out. As far as alternatives go, it's definitely been a bigger topic, or a larger topic that we've talked about over the last few years, and have seen a lot of our clients interested in those. And we kind of put them in 3 different buckets. It's really your private real estate, private equity, and then private credit, and also, I guess, if you want a fourth one, is infrastructure. And we've been adding those to portfolios. One of the benefits is there's somewhat of a illiquidity premium there, so you don't see those things priced on a daily basis, so you get a little less volatility there. And I think they have a place in portfolios. I think you got to talk to your advisor on those things because it's not suited for everybody. You know, a lot in the alternative space is what you're buying, not just the asset class, because there's a bigger dispersion among returns. So you definitely make sure you're buying something in the higher quality space, and we work with our colleagues at Hightower to help us do that as well. So if you have questions, I think that's a great thing to reach out to. I think one of the other themes that we've used in our portfolios is the asset managers that do alternatives are doing very well as well. There's talk about putting alternatives in 401ks and target funds going forward, and I think that's a whole other area of growth. So I definitely think they have a place in portfolios, but I would have a discussion with your advisor on what are the pros and cons and what are the liquidity issues with those going forward. So I think everybody needs to understand that as they move forward.
Got it. I want to, you had touched earlier on that question about the Fed cutting rates later in this year. And so what tactical opportunities are available, or should people be thinking about in advance of Fed rate cuts? And for example, I'm thinking, cash and money markets have had pretty nice yields. Money markets are right around 4%, maybe slightly above, which
Yeah.
is not really too bad for sitting on cash. But if we start to see rate cuts, you're obviously going to see the rates on those money markets come down. What alternative paths going forward should people be thinking about? And what are we thinking about from a tactical standpoint?
So as you pointed out, the returns on cash have been pretty good, and for a long period of time, they were pretty much zero, right? Very
Right.
low. And Then we got them up to, I think, a little over 5%, and they've been holding around 4.25, I think, give or take, right now. But I think they're above 4, but not as much. And I think they're going to hold steady there until the Fed does start to cut rates. September seems like the most likely cut, and it's probably 25 basis points, and there'll probably be another one in December. Again, a lot of those things depend on how some of the geopolitical issues play out, which I mentioned earlier. So I do think the parking it in the money market and getting a 4% return is probably going to be coming to an end here in the second half of the year. Doesn't mean that it won't be above inflation, so it's not a horrible place to park money. But we have started looking at increasing our fixed income allocations and maybe drawing down some of our cash allocations, because again at 4 to 5% on cash, which is about the lowest risk you can get, it was a pretty attractive rate. I do think, unfortunately, that's coming to an end. So we are, from a tactical standpoint, kind of rethinking that, and we'll probably be moving marginally, maybe 1% or 2 back into bonds from holding in cash, because I think all good things come to an end eventually. And I think the returns on money markets will start to come back down. I guess it really depends how aggressive the Fed's going to be. They think they're going to cut twice next year, but we have to get through this year first, so we'll see.
Gotcha. I think that's a lot of the questions that we have as I look over kind of what has been coming up in themes and different discussions with clients and whatnot. Anything on your end, John, that you've been seeing that you want to share that maybe I haven't touched on here?
Well, I just think, the flip side of it, I guess if it didn't come through, I think we're fairly bullish on the markets, cautiously bullish, I would say. I do think equity markets, they tend to peak in December, not in February, which everybody was concerned about earlier this year. We have seen a new high. I think, we'll probably muddle along here at some point in the summer. We did make a pretty big move. I think it was 23% off the low. So there's probably a digestion period here, but I do think we haven't seen the highs for the year yet. It's probably most likely, in the back half, call it the fourth quarter, but most likely December. As far as the bull market goes, we're in what I think is the third year, and they tend to go on for several more. We had, pretty good breadth thrust, and that's a technical term, back in April, which tends to mean there's further legs in the market, and we've been keeping a close eye on that. But on the flip side, there's always that wall of worry that you're concerned about, what could happen next. We have a budget battle coming up. I know we went through the whole reconciliation process for the tax rates, but we still have to pass a 2026 budget, which will start October 1st. So at some point, we could have the whole discussion on a government shutdown and all that process over again. That tends to be, one of those concerns out there. So then there seems to be a little bit of a lag here, but there's this tension between the administration and the Federal Reserve, and obviously the president would like to see the rates cut quicker. The chairman is waiting for more data points from the tariffs, so that's going to be another thing we're going to see going back and forth over the next few months, I'm sure. So there's always something out there to worry about, but I think overall, if you take that all into consideration, we're still pretty optimistic. Still like the cyclicals, like I mentioned. If you look at the economy, the job market still looks pretty good. We look at the company surveys from Evercore, which is a proprietary survey, but they're holding above what is recessionary levels. So, as we see it today, things look like there's more tailwinds than headwinds at this point.
Gotcha. Well, I think that's about all the time that we have, John. Thank you very much for sharing your insights. Much appreciated. There's a lot of ground that we could cover, and I think we just scratched the surface on a couple of themes and topics today. For those of you listening, thanks for taking the time. If there's questions that you have that we did not touch on, by all means, please reach out to your advisor. And they're more than happy to connect you with the investment team and share additional insights on whatever questions you might have. But thank you again for your time, and enjoy the rest of your summer, everyone.